You are paying school fees, you are paying rent, or maybe the interesting part is you are not paying either of these things. You are simply funneling money from your credit card directly into a bank account, and that bank account could be of your relatives or someone you trust. So basically, you have access to that money. In short, you have successfully managed to cash out your credit card. And now coming to the system, it thinks you are a tutor or a tenant. Welcome to India's MCC problem, a story about 4-digit codes, thousands of crores in lost interchange, a regulator that has been quietly tightening the screws, and an industry that gamed the system so long it forgot where the rules ended and the business began. Hello, I am Aarti Singh and welcome to the Head and Tail video. A lot of you asked for an explainer on MCC and here we are. Let's start at the beginning. Every business that accepts a credit or debit card or digital transactions is assigned a 4-digit number called a merchant category code, MCC for short. A grocery store has one, a flight booking has another, a school has a different one altogether, and a bill payment has a different code. These codes are not just labels. They are the financial system's way of asking what kind of transaction is this, how risky is the merchant, and how much money flows where. Here's where it gets interesting. Different MCCs carry different interchange rates. Can also be called MDR, merchant discount rates. This is the fee businesses pay on credit and debit card transactions. The fee then gets distributed among acquiring bank, card networks, and issuing banks, which is basically the cardholder's bank. Interchange rate for education payments, for instance, is at around 0.6 to 0.7%. The idea was digital payments for school fees should be affordable as it is a low risk and low fraud business, hence low interchange. E-commerce, travel, standard retail, the interchange is closer to 1.8 to 2%. The gap is roughly 1.2 percentage points, and this is where this whole story begins. Because in a country processing tens of thousands of crores in card transactions every month, even a fraction of a percent is worth enormous amounts of money. And where there is money, there are people willing to find clever ways to reach it. Let me walk you through the playbook. This is how MCC arbitrage worked in practice. Take the education MCC. It was intended for schools and colleges collecting tuition fees. Legitimate use case, legitimate discount. What some payment aggregators and the merchant partners figured out was this. What if we route other transactions through this cheaper code? So gaming platforms, e-commerce companies, and some other businesses, they would be onboarded under the education MCC. The interchange savings would flow to them. The merchant got a lower MDR, the payment aggregator won the merchant's business by offering a cheaper rate. Everyone was happy, except the bank that issued the credit card. They were receiving low risk, low interchange money for what was actually a high risk e-commerce transactions. And then there was a more brazen version. Individuals were onboarded as tutors. A user would pay 10 lakh rupees to a tutor via credit card, earn reward points, essentially a card to cash transaction, disguised as education spending. The bank issuing the card, receiving low interchange, so a clear loss for them. Let's quickly run the scoreboard. The merchant wins, lower MDR. The payment aggregator wins, it undercuts rivals on pricing and wins volume. The card network wins, it gets transaction throughput. The acquiring bank wins because volume is volume and they get the float income. The only loser, the issuing bank, the entity that actually gave you the credit card. Education wasn't the only low interchange corridor being gamed. Think of it as a series of doors and one by one they have been shut. Utilities first. The MCC 4900 for electricity, gas, water also carried low interchange, around 0.8 to 1%. For years, merchants with no connection to essential services were slotted into this bucket. Fintechs onboarded all sorts of businesses as utility providers to keep MDR low. Then in late 2025, MasterCard increased interchange on utilities. RuPay followed. And in November 2025, as the Head and Tail first reported, Visa formally discontinued its discounted interchange program for utilities in India. The rate jumped to 1.8 to 1.9%. Effectively overnight, that corridor was gone. Now comes railways. There were instances where few payment aggregators had onboarded major online travel agencies and processing flight tickets under the Rail MCC, which carries interchange of just 0.75 to 0.9%. Air travel MCCs, on another hand, would have attracted 1.65%. When a complaint triggered RBI intervention, aggregators were asked to stop processing that way. Now this one you may have felt personally, and this is rent. Apps like PhonePe, Cred, Checks, Paid and many others allowed users to pay rent via credit card, earning reward points, managing cash flow. In September 2025, the RBI's new master directions on payment aggregators effectively shut this down. A payment aggregator can only settle funds to a registered KYC verified landlord, which left one low-cost corridor still standing, and that is education. And as one industry source told us, education was the last nail in the coffin. The ecosystem is now being fined for the misuse they enabled. Issuer banks raised complaints with card networks reached out to acquiring banks passed the fines down to payment aggregators. The chain of accountability, long ignored, is now moving in reverse. So how did the regulator respond? The RBI's approach is interesting because it wasn't primarily about protecting interchange. The RBI doesn't get into commercial disputes between banks and networks. The concern was something more fundamental, and that is data integrity. When a high-risk e-commerce transaction is reported as a low-risk education payments, the RBI's entire risk monitoring picture gets distorted. It relies on these classifications to supervise the financial system. Misreporting is not just a commercial problem, it's a regulatory problem. So what did they do? In Feb, before taking a broader action on education MCC misuse, they called all major payment aggregators and they were asked to share granular data like their top MCCs by volume and their top 5 merchants within each MCC. The scale was staggering. Education MCC transaction combining genuine and misused volumes were running at over 50,000 crore rupees per month across payment aggregators. Immediately after the meetings and RBI scrutiny, almost all payment aggregators stopped processing on education MCC. And the estimated commercial impact, a wipeout of roughly 20 to 25,000 crores monthly volumes from the industry books. On the banking side, ICICI Bank has formally filed interchange claim against acquiring banks for MCC misuse in utilities and education payments, using a visa dispute mechanism that had existed for years but nobody had ever actually used. And according to sources, NPCI has also come up with its own mechanism for RuPay recently. A conversation the industry had long preferred to keep buried was now officially open. So where does this leave the industry? For large payment aggregators, those with IPO ambitions, diversified revenue streams, the impact is painful. These were high volume flows and increase the top line. The hit will show up in the annual numbers and even in IPO papers for some, but they'll somehow manage. For smaller aggregators, the picture is more existential. Many build their entire merchant acquisitions strategy around MCC arbitrage, offering a merchant 1% MDR when competitors were charging some 1.6%. That was the pitch. The pitch is now gone. And the most interesting part is not everyone is complying fully. We have heard from sources that some aggregators have simply shifted tactics, keeping individual transactions values under 40,000 rupees to stay below alert thresholds, while increasing transaction counts. The evasion continues, just in a more distributed form. Now you see a pattern. Over the last few quarters, the gaming crackdown, the rent ban, the tightening on corporate credit cards, workarounds, and now education MCC, each individually significant. Collectively, they represent a systematic dismantling of the low interchange playbook that an entire generation of Indian fintech was built on. At its core, this is not a story about interchange rates or 4-digit codes. It is a story about what happens when a fast-growing industry outpaces its own governance, when the incentives to game the rules become stronger than the incentives to follow them. The RBI's tightening is not punitive, it is corrective. The central bank is trying to ensure that what flows through India's payment rails is what it says it is, that a school fee actually is a school fees, and that a utility payments, it's genuinely paying a utility. For the executives building fintech companies today and for the VCs backing them, the message is clear. The low-friction arbitrage era is over. What survives will be built on genuine value, not regulatory gaps. India's payments market is still one of the most exciting in the world, but the easy money, that chapter is closing. Now that might have sounded scary, but don't worry, some of this is already coming back. Rent payments are back, all kosher now apparently. Make of that what you will. A lot of IPO-bound payments companies had numbers at stake. So the question is, what else comes back? And what new MCC does the ecosystem quietly find next? Because if history is any guide, the workaround always arrives before the regulator does. On that note, thank you for following us and our stories. If you found this useful, please subscribe our channel.